Your bank has never once told you the truth about why it exists. It's not there to keep your money safe. Vaults do that. It's not there to help you get ahead. That's not how the numbers work. And if you look closely, you'll see it. Your bank exists to make money off you. Every single account, every single card, every single convenience fee. All of it is engineered, tier by tier, to extract the maximum amount of profit from whoever walks through the door. And the wild part is, the amount they make off you doesn't shrink as you get richer. It just changes shape. Today, we're walking through exactly how banks profit off you at every income level, from the person living paycheck to paycheck who gets hit with a $35 overdraft fee, all the way to the ultra-wealthy client who never pays a fee in their life, but somehow makes the bank even more money than everyone below them combined. By the end of this video, you'll never look at your bank statement the same way again. Let's start at the bottom. Tier 1, 0 to 25K, the fee machine. You open a checking account because you have to. Direct deposit, bill pay, a debit card for groceries. This isn't optional in the modern world. So you walk into a bank, or more likely, you open an app and you sign up for what they call a free checking account. It is not free. It was never free. It's just free until it isn't. The first month goes fine. Then a bill hits 3 days before payday and your balance dips $2 below zero for about 6 hours before your next paycheck lands. The bank charges you $35 for that. Not because it costs them anything. The transaction clears instantly. Computers do this in milliseconds. But because the overdraft fee is one of the single most profitable products in their entire portfolio. Here's a number that might surprise you. Banks in the United States collect billions of dollars every single year in overdraft and insufficient funds fees, and the overwhelming majority of that money comes from a small percentage of account holders who get hit with these fees repeatedly. It's not spread evenly across everyone. It's concentrated on people who are already living close to the edge. That's not an accident. It's the business model. Then there's the minimum balance fee. Keep less than a certain amount in your account, often $500 to $1,500 depending on the bank, and you'll get charged a monthly maintenance fee just for the privilege of having an account at all. You're paying the bank to hold your money, while they turn around and lend that same money out to someone else at interest. Your debit card feels free too. It isn't. Every time you swipe it, the merchant pays what's called an interchange fee, usually 1 to 3% of the transaction, and that fee gets split between the bank and the card network. You don't see it. It's baked into the price of everything you buy. But your spending, every single swipe, is generating revenue for your bank in the background, all day, every day. And if you ever need a short-term loan because your car breaks down or your rent is due before payday, and your credit isn't strong enough for a traditional loan, you're funneled toward products with interest rates that can run into the triple digits annualized. Payday loans, some credit builder cards, certain overdraft protection lines, all marketed as help, all structured to generate far more in interest and fees than the amount you originally borrowed. At this tier, the bank doesn't need you to have money. They need you to almost not have money, because that's when the fees hit hardest, and that's when you're least able to walk away. Tier 2, $25,000 to $75,000, the interest trap. Now you've got a steady paycheck. You're not overdrafting every month anymore. You've graduated, in the bank's eyes, from fee income to something more valuable, interest income. You've got a credit card now, maybe two. You pay most of the balance most months, but not always all of it, and that's exactly where the bank wants you. A cardholder who pays in full every month is called a deadbeat internally in the credit card industry, not because you did anything wrong, but because you cost the bank money. No interest, no revenue, just processing costs. A cardholder who carries a balance, even a small one, is called a revolver, and revolvers are the golden goose. The average credit card interest rate sits in the 20% range, and if you're carrying even a modest balance of $2,000 or $3,000, that's hundreds of dollars a year in pure profit for the bank, generated from money you already spent on things you already own. Then there's your auto loan. You needed a car, so you financed one, and the dealership offered to handle the financing for you. What they didn't mention is that dealerships often mark up the interest rate above what the bank actually approved you for and pocket the difference, a practice called dealer reserve. So you might qualify for a 6% rate from the lender, but the dealer quietly bumps it to 8%, and that extra 2% becomes pure profit split between the dealership and the financing bank. Your mortgage, if you have one at this tier, works similarly, but at a much larger scale. A 30-year mortgage is structured so that in the early years, the overwhelming majority of your monthly payment goes towards interest, not principal. You could pay for a decade and barely dent the actual loan balance. That's not a conspiracy, it's just how amortization math works, but it means the bank collects the bulk of its profit early while you build equity slowly. And here's the part most people never think about. Your bank is also lending out your own deposits. The money sitting in your checking and savings account isn't just sitting there. Banks are required to keep only a fraction of deposits on hand. The rest gets lent out to other customers at interest rates far higher than the nearly 0% they're paying you for keeping your money with them. You're being paid maybe 0.5% on your savings account. The bank turns around and lends that same money out at 7, 8, 9% on a personal loan or a credit card to someone else. The spread between what they pay you and what they earn lending your money out at is one of the oldest profit models in banking, and it works quietly, in the background, every single day your money sits in that account. Tier 3, $75,000 to $200,000, the product bundle. Something shifts here. You're no longer just a fee target or an interest source. You're a relationship they want to expand. You get a phone call or a friendly banker flags you down during a bank visit. Have you considered opening a home equity line of credit? Have you considered our premium checking tier? We noticed you might benefit from a financial review. This is called cross-selling, and at this tier, it becomes the primary profit engine. The bank already has your checking account, so now they want your savings, your credit card, your auto loan, your mortgage, and ideally your investment account too. Every additional product you open isn't just extra revenue, it makes you dramatically less likely to ever leave, because untangling 5 linked accounts from one bank is a hassle most people avoid. Your premium checking account waives some of the fees that hit you in Tier 1. No more $35 overdraft charges, maybe free checks, maybe a slightly better savings rate. But you're paying for that upgrade somewhere. Often it's a monthly account fee disguised as a relationship fee, or a requirement to maintain a much higher minimum balance, which is itself money the bank can now lend out. If you've bought a house at this tier, you're a prime target for a home equity line of credit, essentially a second loan secured against the value of your home. Banks market these aggressively at this income level because the collateral is strong, the risk is low, and the interest earned is significant. It's often framed as unlocking your home's value, but from the bank's side, it's simply another interest-bearing product layered onto an asset you already have. And you've probably also been offered access to a financial advisor within the bank, sometimes framed as a free perk of your account tier. What's often left unsaid is that many of these advisors earn commissions on the specific investment products they recommend, which may not always be the lowest cost or best performing option available to you. The mutual funds or managed portfolios they steer you towards often carry higher fees than a simple, low-cost index fund you could buy yourself, and those extra fees, as small as they look on paper, compound over decades into a significant amount of money that moves from your account into the bank's. At this tier, the profit model shifts from extract fees from financial stress to expand the relationship and maximize the number of products touching your money. You're not struggling anymore, so the fee income shrinks, but the volume of products replacing it more than makes up the difference. Tier 4, $200K to $1 million, the private banker. Now the bank assigns you a name, not a customer ID, an actual person, a private banker or a relationship manager, someone whose entire job is to manage your accounts personally. This feels like a perk, and in some ways it is. You get faster service, direct phone access, and someone who actually remembers your name when you call. But underneath that convenience is a very deliberate profit strategy. The more personalized the service, the more products the bank can place with you, and the more comfortable you feel keeping your entire financial life under one roof. Your private banker will likely offer you a securities-backed line of credit, a loan where you borrow against your investment portfolio instead of selling assets. This sounds sophisticated, and it is a legitimate tool used by wealthy families to avoid triggering capital gains taxes, but it's also an extremely profitable product for the bank because the collateral, your portfolio, is liquid and low risk, meaning the bank can lend against it confidently while charging you meaningful interest on the loan. At this tier, you're also introduced to wealth management as a formal service, not just an occasional advisor conversation. This typically comes with an annual fee calculated as a percentage of your total assets under management, often around 1%. That number sounds small. On a $500,000 portfolio, it's $5,000 a year, whether your investments go up, down, or sideways. Over a 20 or 30-year investing horizon, that 1% fee compounding against your compounding returns can quietly consume a shockingly large portion of your total wealth, sometimes hundreds of thousands of dollars that would have otherwise stayed invested and growing. Your mortgage at this tier likely looks different too, a jumbo loan exceeding the conforming loan limits, often with a slightly higher interest rate to compensate the bank for the larger risk. But because the loan amount is so much bigger, the total interest paid over the life of the loan is enormous, even at a similar percentage rate to what someone at tier 2 is paying. You're also a strong candidate now for premium credit cards with steep annual fees, $400, $500, $700 a year, marketed heavily around travel perks and lounge access. Some of that value is real, but the annual fee itself is guaranteed immediate profit for the bank, collected whether you use the card once or 100 times a year. And the spending rewards you accumulate are often funded in part by the same interchange fees merchants pay on every one of your purchases, meaning the free travel points were never really free. They were paid for in advance by you through the fee and through slightly higher prices on the goods you bought. At this level, the profit model is refined and personalized. It's not about fees from financial stress. It's about a curated menu of high-margin products delivered with a smile and a direct phone line, designed to keep your entire net worth flowing through one institution. Tier 5, 1 million to 25 million. The invisible margin. Here's where most people watching this video have genuinely never been, and where the bank's profit model becomes almost impossible to see from the outside. At this tier, you don't pay fees. You don't pay annual charges on your accounts. In fact, most of the visible costs disappear entirely. Your private bank waives nearly everything because the profit isn't coming from fees anymore. It's coming from something called the spread, and it's happening on a scale that dwarfs anything from the tiers below. Your bank now manages tens of millions of dollars in assets on your behalf. Even a management fee of 0.5%, which sounds tiny and reasonable, generates enormous revenue when applied to a portfolio this size. On $10 million, 0.5% is $50,000 a year, collected quietly, consistently, regardless of market performance. You're also introduced to proprietary investment products, funds created and managed by the bank itself, rather than independent, low-cost alternatives. These products carry structuring and performance fees layered on top of the base management fee, and because they're proprietary, you have limited ability to compare their true cost against the broader market. The bank profits not just from managing your money, but from the specific products they steer you toward, many of which you'd struggle to buy anywhere else at a lower cost. Your borrowing changes shape entirely too. At this tier, you rarely take out a traditional loan. Instead, you use lending strategies built around your assets, borrowing against real estate, against business interests, against investment portfolios, often at rates far below what a tier 2 or tier 3 client would ever be offered, because the risk to the bank is minimal and the relationship is worth protecting. But even at a lower rate, the sheer size of these loans, often in the millions, generates interest income far exceeding what dozens of smaller loans combined would produce. Currency exchange, international wire transfers, estate planning services, trust management, all of it flows through the same institution now, each carrying its own margin, its own quiet fee structure, invisible unless you go looking specifically for it. And because you trust the relationship, and because the alternative, disentangling your finances from one bank and rebuilding it across several institutions, feels like more effort than it's worth, you rarely go looking. The strange truth about this tier is that the less you notice you're paying, the more you're actually generating for the bank. The absence of visible fees isn't generosity, it's a more sophisticated form of the exact same business model that charged you $35 for an overdraft back at Tier 1, just moved further from view and scaled up by a factor of thousands. Tier 6, 25 million plus. The bank works for itself through you. This is the tier where the relationship fundamentally inverts. At every level below this one, you are in some sense a customer the bank was extracting value from. At this level, you become something closer to a business partner, someone whose capital the bank actively wants to deploy, invest, and grow alongside its own institutional money because your success and the bank's success are now genuinely intertwined. You're not assigned a private banker anymore. You're assigned a team, a dedicated group spanning tax strategy, estate planning, investment management, and sometimes even philanthropic advising, all coordinated specifically around your financial life. This team costs the bank real money to maintain, but the assets you bring in generate revenue on a scale that makes the costs trivial by comparison. At this level, banks compete aggressively just to have your business at all, often waiving fees entirely and offering below-market lending rates, because the value isn't in the fee income anymore. The value is in the assets under management, the co-investment opportunities, and the prestige of having your name quietly on the client roster. You're offered access to opportunities that never reach the tiers below you: pre-IPO investments, private equity funds, exclusive real estate deals, structured products built specifically around your tax situation and estate goals. The bank profits from these in ways that are almost never disclosed as a simple percentage fee. Sometimes it's a placement fee for getting you into a deal. Sometimes it's a share of the profits generated. Sometimes it's simply the deepened relationship and the near certainty that your capital will keep flowing through their institution for decades, and eventually through your children's accounts as well. Your money doesn't just sit at the bank anymore. It becomes part of the bank's own balance sheet strategy, used to back further lending, further investment, further institutional growth, in ways that regular depositors' money is used too, but at a scale and level of coordination that fundamentally changes the relationship. And here's the part that should genuinely surprise you. At this tier, some of the largest private banking relationships operate at a near break-even cost to the institution in terms of direct fees, because the real profit isn't the fee at all. It's the scale, the prestige, the referral network, and the decades-long compounding relationship with the wealthiest families a bank can attract. You've gone from being a fee generator to an interest source to a cross-sell target to a private relationship to, finally, a genuine partner in the bank's own growth. The system hasn't stopped extracting value from you. It's simply become sophisticated enough that the extraction and the partnership look exactly the same from the outside. Let's put it side by side. At $20K, the bank makes money charging you $35 for being $2 short for 6 hours. At $100K, the bank makes money bundling 5 products into your life and quietly steering you toward the ones with the highest margin. At $2 million, the bank makes money through fees so small as a percentage that you'll never notice them, applied to a balance so large that the total dwarfs everything below it. At $50 million, the bank barely charges you directly at all, because your capital itself has become part of how the bank makes money elsewhere. The wild part isn't that the fee structure changes. Everyone assumes that. The wild part is that the total amount the bank profits from you doesn't shrink as you climb, tier after tier, even as the visible fees disappear entirely. The person paying the least in obvious charges is very often generating the most revenue of anyone in this video. And every single person in this video believes genuinely that their bank is helping them. That's not naive. The system is built specifically so that help and profit extraction look identical from where you're standing. Here's what I want you to sit with. Every single person in this video walked into the same kind of building, signed similar looking paperwork, and trusted the same basic promise. Your bank is here to manage your money. And in a narrow technical sense, that's true at every tier. But underneath that promise, at every single income level, the bank has built a specific, deliberate way to make money off you, and the sophistication of that system only grows as you do. The overdraft fee at the bottom and the co-investment opportunity at the top aren't different businesses. They're the exact same business, wearing different clothes depending on how much you're worth. So the next time your bank offers you something, a new card, a premium account, a friendly conversation about your financial goals, it's worth asking a simple question. Not, is this good for me? Almost everything they offer will have some real benefit. The better question is, how is this good for them? Because once you can see that answer clearly, at any income level, you start making very different decisions with your money. If this changed how you'll look at your own bank statement, you know what to do. Subscribe, because next week we're going even deeper into where your money actually goes once it leaves your hands. See you in the next one.